Hey, what's up, guys? In this video, I'm going to have my good friend Steve Penny, market analyst. He's going to be breaking down the different calls that Dr. Michael Burry made for hyperinflation, whereas Jim Rickards is talking about a deflationary environment. He's going to be analyzing all the possibilities, whether it's hyperinflation, sustained inflation, or massive deflation, market crashes, so you know how to prepare for it in all the ways possible. This is a fantastic video. You're really going to enjoy this one. I just want to mention Steve's free newsletter is Silver Chartist. It's right there down below in the comments, pinned as the first comment, and in the description. It's the best free newsletter out there to understand what's happening in the markets, and an awesome gold, silver, and commodities stock newsletter as well. So I want to mention that and encourage everyone to sign up to that for free. It's right there down below. And now let's hear it from Steve.
Well, Jake, thank you so much for that kind introduction, and thank you again for inviting me on for a guest post on your awesome channel here. So today we're going to be talking about inflation versus deflation, and more specifically, we're going to be breaking down Jim Rickards' forecast, at least over the short to intermediate term, for disinflation or even deflation, compared to Michael Burry's recent calls for hyperinflation here in the United States. Now, if you missed it, Jake and I did a call breaking down Michael Burry's hyperinflation calls that was released on his channel back on September 21st. I would encourage you to go back and check that out if you'd like. So the big question, who's going to be right? Is it going to be inflation or deflation? And in my opinion, both will actually be right, just in different time frames, but we'll expand on that in a few minutes. So before we get too far into today's discussion, let me define a couple of terms. First of all, inflation. Inflation is not a rise in prices. Inflation is an increase in the currency supply. Rising prices are a symptom of inflation. Conversely, deflation is a decrease in the currency supply, which results in lower prices. Now, a third term that doesn't get talked about too much is disinflation. And what disinflation is a slowing of the pace of inflation. And you can make a case that perhaps we're seeing a bit of that now. We're still seeing increasing inflation, just at a slower rate than we did before. Now, as you'll see right here on the screen, PCE, or personal consumption expenditures, is the Federal Reserve's favorite inflation metric. And you can see that it's been trending steeply higher since April of 2020, and then it went almost parabolic in the first half of 2021. And in the last several months here, the rate of change has slowed just a little bit, but it is still trending steadily higher. And the mainstream narrative that inflation is quote-unquote transitory may be losing credibility, as even the highly flawed government data shows persistently high inflation. Now, as I mentioned before, there's two gentlemen who I have a lot of respect for who have very different perspectives on the inflation versus deflation debate, and of course those are Jim Rickards and Dr. Michael Burry. Now, if you're not familiar with Dr. Burry, he's the one who made a name for himself shorting subprime mortgages leading up to the 2007-2008 financial crisis, making hundreds of millions of dollars for himself and his clients. And he was one of the main characters portrayed in the movie The Big Short. So as I mentioned before, what I've learned over the years is that when you have two well-reasoned, intelligent analysts that draw diametrically opposed opinions, often both analysts can be right, just in different time frames. And I think that could be the case here. So let's start with Jim Rickards' disinflation or deflationary argument over the short to intermediate term. And I'll just tell you one pushback I might have to the way he frames this debate is he presents two sides. The narrative that we're going to see high economic growth paired with inflation, or slowing economic growth paired with disinflation or deflation. Now, those are two possibilities. However, there's a third possibility that I haven't heard him talk about yet, and that's stagflation. And my personal opinion is that stagflation is the most likely path forward. And stagflation results when you have slowing economic growth paired with persistently high inflation. And that's the worst of both worlds. And unfortunately, I think that's where we're headed into. And that's what we saw in the 1970s, specifically the late 1970s, when silver and gold and commodities in general performed their best. So one thing Jim Rickards points out is that the Fed is expected to taper here in November of 2021 in just a few weeks. And I actually think that's very likely. Currently, the Federal Reserve is creating $120 billion out of thin air each and every month. And with that, they're purchasing $80 billion of Treasury securities and $40 billion a month of mortgage-backed securities. And their stated plan is to begin scaling that back. And their plan is to begin scaling that back next month in November at a rate of roughly $15 billion per month. And the idea is to have the taper finished and no more accommodative monetary policy by late 2022. And then once the taper is complete, the Fed is saying that they're going to begin to normalize interest rates or raise interest rates. Now, you and I both know that's probably not going to happen. But if past is prologue, they just may be foolish enough to try it and tighten into a weakening economy, which could lead to some short-term disinflation. And that's to Jim Rickards' point. Jim's also been talking about the heightened risk for a global liquidity event, which perhaps could be sparked by this Evergrande crisis that's unfolding as we speak in China. This could easily have contagion effects globally and initially be a deflationary force, but if the situation continues to escalate, I think that would ultimately result in global central banks opening up the monetary spigots even more. So ultimately, any deflationary impulse would be met by even more monetary stimulus and even more inflation going forward. Jim also talks about government reactions to the cerveza sickness. We'll just call it that here. He doesn't call it that, which has obviously been a headwind to global growth and been a deflationary force. And I have to agree with him that it's not so much the sickness that has been the headwind, although that's certainly part of it, but it's been more government reaction that has caused the most damage. And then finally, Jim correctly points to slowing monetary velocity. As you can see in the chart I'm about to put on the screen, the velocity of money has been slowing since the late 1990s. You can see on this chart it's just been trending lower for over 20 years now. Now, you could make a case that the all-time low reading that was marked in March of 2020 was the low, and that the trend may be trying to reverse, but it's admittedly way too premature to make that call. I would not be surprised at all if it actually had. All right, now let's switch gears and talk about Dr. Burry's inflation or hyperinflation argument for the United States. But before we do, let me play this brief clip of Dr. Burry on 60 Minutes over 11 years ago now, where he recounts his experience of making hundreds of millions of dollars shorting the subprime housing market in 2007 and 2008. The key takeaway from this clip and from his other comments has been, number one, that to be right on a contrarian trade, you have to be prepared to be wrong for a period of time where people ridicule you and mock you before you're eventually proven right. But very often you have to be wrong first. So let's go ahead and play that clip.
So how much of these things did you buy? I mean, you got out of everything else and bought credit default swaps betting against the housing market, right?
Right. We bought basically short $8.4 billion of credit default swaps related to mortgages or financial companies.
You must have been pretty confident that this thing was going to blow up.
Well, we had a giant bet for us, and I was extremely confident in the outcome.
Were your investors as confident?
I think a few investors were.
Some of them thought you were crazy. Some of them probably thought you'd lost your mind.
I know for sure that some of them thought I lost my mind.
So you made a ton of money?
Made a ton of money. Much more than I ever imagined, I'd ever have.
Were your clients grateful?
I think a lot of clients were just glad to be done with it at the end.
Even though they doubled their money?
Well, we made $725 million, I think, on the funds in 2007, and in the first 6 months of 2008, there was about $730 million in withdrawals. Perhaps I had made the trade too big for the fund, and my confidence in the trade had ticked off some people.
Even though you made them rich?
It's remarkable. There are investors who made tens of millions off this, and we're still pretty upset.
Another thing that really jumped out to me in that clip is how he described the investors who actually stuck it out and made millions of dollars right alongside of him. But he said, honestly, they were just happy it's over. How many of you guys out there can relate to that who have been in the silver, uranium, or gold markets for any period of time? It's been long and tedious, but I think in the end it's going to be worth it. We're beginning to see the fruit in the uranium sector, and I believe that silver is not far behind. So let's talk about some of Dr. Burry's recent tweets that suggest hyperinflation is in store here in the United States. Now, before I read his tweets, I want to mention that it seems that a lot of his reference material comes from a book called Dying of Money, Lessons of the Great German and American Inflations, which is a fantastic book, and I highly recommend anyone check it out. It was written in the 70s. And Dr. Burry thinks what unfolded in Germany is a blueprint for what's set to unfold here in the United States. So I'm just going to go ahead and read a couple of his tweets to you where he cites the Dying of Money book I just mentioned. So he says, prices in Germany were steady, and both businesses and the stock market were booming. The exchange rate of the mark against the dollar and other currencies actually rose for a time, and the mark was momentarily the strongest currency in the world on inflation's eve. Now, we can obviously see that parallel right here in the United States today. Obviously, the dollar is being debased at a rapid rate, yet when measured against other fiat currencies, sometimes the dollar actually rises, and that's consistent with what happened in Germany prior to their hyperinflation. I'll read another tweet Dr. Burry put out. Side by side with the wealth were the pockets of poverty. Greater numbers of people remained on the outside of the easy money, looking in but not able to enter. The crime rate soared. So this is an interesting parallel to what we see today as well, as the wealth gap here in the United States has never been so broad, and the primary blame for that wealth gap lies squarely at the feet of the Federal Reserve. The more currency they create out of thin air, the more it benefits the wealthy and the more it hurts the lower and middle class. Two more tweets here. He says, speculation alone, while adding nothing to Germany's wealth, became one of its largest activities. The fever to join in, turning a quick mark, infected nearly all classes. Everyone from the elevator operator up was playing the market. Now, again, that's a parallel that we can see today. A lot of people are speculating in highly volatile, highly risky assets, making a lot of money, and a lot of them are honestly unsophisticated investors. He talks about the elevator operator back in 1920s Germany. We can see that today with speculators in GameStop and some of these meme stocks, or even some of the altcoins. This behavior is very characteristic of what typically precedes massive inflation. All right, one final tweet here I'm going to read for you guys. Throughout these years, the structure was quietly building itself up for the blow. Germany's inflation cycle ran for not a year, but 9 years, representing 8 years of gestation and only 1 year of collapse. So the comparison here is 2010 to 2021 without those periods of gestation and 1 year of collapse. I think of David Morgan's quote where 90% of the move happens in the last 10% of the time. I think that's probably how it's going to unfold this time. Whenever inflation does rear its head in a big way, I mean much bigger than what we're seeing now, I think it's going to happen fast. And the majority of the move is going to happen in the very last period of time. So what's my personal take on this? I think we could very likely see a deflationary impulse followed by then runaway inflation. And right now, I think all eyes need to be on the general equities and stock market because let's say a 20% pullback. I hate to use the word crash, but let's say there was a 20-25% pullback in general equities. I think that would very quickly cause the Federal Reserve to reverse course on any taper talk or any talk about raising interest rates in the near term. And in fact, I think a pullback like that would cause them to turn on the monetary spigots even bigger than we've seen before, which would finally result in even higher inflation and would likely be a major catalyst for silver and gold. But one thing I have learned over the past 15 years of being in these markets is that rather than trying to predict every short-term move is having a personal strategy to handle a variety of different outcomes, especially over the short term. And that's what we focus on in the weekly Silver Chartist report. So I hope you found this short video helpful. And don't forget to help support Jake's channel by liking this video if you found it valuable, or forwarding it to any friends and family. Thank you guys so much for your time and look forward to speaking to you soon.
Okay, if you enjoyed this video, make sure that you check out Steve's free newsletter. It's Silver Chartist. It's right there down below. It's pinned to the comments and in the description right there down below. If you enjoyed this episode, give us a comment down below and let us know if you'd like to see more of these guest posts coming in from my good friend Steve. Hit the like button on this video, bell notification, all that good stuff to send it out in the YouTube universe. And be sure to check out the Silver Chartist newsletter for free right there down below in the description and pinned to the comments for the latest updates on the macro and economic environment climates, and specifically gold, silver, and commodity mining stocks, and how to prepare for everything that's coming.